Good morning, student. Welcome back. Today we will start our new chapter, that is accounting principle. Nowadays, every business is generally related to many individuals and institutions. For example, creditors, banks, investors, government, etc. It is therefore essential that financial statements should be prepared according to certain rules, procedures, and convention. These rules and conventions are called as generally accepted accounting principles. If the accountant do not adopt the generally accepted accounting principles, the accounts and financial statement of different organizations will not be comparable. The work of accounting will be understandable to all the persons and institutions only when is done on the basis of standardized terminology, language, principle and element. These fundamental element means accounting principle, accounting concept and accounting conventions. Meaning of accounting principle. Accounting principles are affected by the government rules and regulation and the opinion of professional institutions such as Institute of Chartered Accountant of India. Thus, they are bound to change with the passage of time so that the presentation of financial statement can be made more meaningful and useful. According to American Institute of Certified Public Accountant, AICPA has defined as a principle as a general law or rule adopted or professed as a guide to action, a settled ground or basis of conduct or practice. These principles are classified into two categories. First one is accounting concept and second one is accounting conventions. Category is accounting concept. Concepts are basic assumptions or fundamental proposition within which accounting operates. The basic accounting assumptions offer a foundation to the accounting process or recording and reporting various transactions. No business entity can prepare the financial statement without considering the basic accounting assumption. The three basic accounting assumptions are going concern, consistency, and accrual according to ICAI. Accounting conventions are the outcomes of accounting practices or principles being followed by the enterprises over a period of time. Convention may undergo a change with time to bring about improvement in quality of accounting information. An accounting convention may be defined as custom or generally accepted practice which is adopted either by general agreement or common consent among accountants. The fundamental accounting assumptions recognized by Accounting Standard 1, that is disclosure of accounting policies, are going concern concept. As per this assumption, it is assumed that business shall continue for a foreseeable period and there is neither the intention nor the necessity to wind up the business in the foreseeable future unless existing evidence suggests otherwise, as this assumption believe in the continuity of the business over an indefinite period of time. It is also known as continuity assumption. According to ICAI, second one assumption is consistency. It refers to the state of accounting rules, concepts, principles, practice and convention being observed and applied consistently year after year. There should not be any change. If consistency is there, the result and performance of one period can be compared easily with the other period. It also prevents personal bias as the persons involved have to follow the consistent rule, principle, concept and conventions. These assumptions, however, does not completely ignore changes. It admits changes if the law or accounting standard require. Next one is accrual concept. Accrual basis is used for recording of transaction. It provides more appropriate information about the performance of business enterprise as compared to cash basis. In accrual concept, revenue is recorded when sales are made or service are rendered, and it is immaterial whereas cash is received or not. Similarly, they assist in earning the revenue whether the cash is paid for them or not. Thus, to ascertain true profit or loss for an accounting period and to show the true financial position of the enterprise at the end of the accounting period. Now, some accounting principles. First one is business entity. According to this principle, business is considered to be separate from its owner. Business transactions are recorded in the book of account from the business point of view and not from that of owner. The business entity concept is utilized in the accounting equation, that is assets is equal to capital plus liability. Next one is money measurement concept. According to this concept, only those transactions and events are recorded which are financial in nature. Non-monetary transactions, irrespective of their importance, cannot simply be recorded. Money is considered to be having a constant or unchanging value since transactions are recorded at the value on the dates they first occurred, and since then their value remain the same irrespective of change in the market value for them. Next one is principle of accounting period. According to this principle, the life of an enterprise is broken into smaller periods so that its performance is measured at regular time interval. The accountant of an enterprise are maintained following the going concern concept, meaning the enterprise shall continue its activity for a foreseeable future. Usually, a period of 1 year is considered as one accounting period. It becomes necessary to close the account at regular interval, and the principle of accounting period is followed to determine such time duration. Under the Company Act, it is compulsory for all the companies to adopt the financial year as accounting year starting from 1st April every year and ended on 31st March next year. Next one is principle of full disclosure. According to this, providing accurate, full and reliable information and data in the financial statement which is of material interest to the users of such statement. This principle is given due to legal emphasis by the Company Act 2013 by prescribing format for the preparation of financial statement. Thus, in a nutshell, the principle of full disclosure requires that all material information must be impartially and honestly disclosed either on the face of the financial statement or in the notes to the financial statement. This principle is of great importance to users such as owners, bankers, investors, creditors, employees, government agencies, etc., since they have great interest in the proceeding of the business. All information cannot be mentioned in financial statement alone. Therefore, footnote to financial statement carry such backlog of information. Some examples are there. First one, method of valuation of closing stock and any change in it. Second, market value of investment. And third one is contingent liability, etc. Next one is principle of materiality. According to this, item having an significant effect of being irrelevant need not to be disclosed, but the main and important information of the business must be disclosed impartially. According to American Accounting Association AAA. An item should be regarded as material if there is reason to believe that knowledge of it would influence the decision of informed investor. In every business, there are transactions or events which are absolutely immaterial and their non recording does not affect the business account. Next one is principle of conservatism or prudence. In the present day uncertainties, the convention of conservatism has its own importance. This principle follows the policy of caution or playing safe. It takes into account all possible losses but not the possible profit or gain. Thus, it is often in the regard of principle of conservatism that do not anticipate a profit that provide for all possible losses. From this principle, it is inferred that a business must provide for likely losses and all known liabilities but not potential gain or income. For example, first one is closing stock is valued at cost price or realizable value whichever is less. Provision for doubtful debt is created in anticipation of actual bad debt and provision for pending lawsuit against the firm which may either be decided in its favor. Next one is cost or historical cost principle. According to this principle, all assets should be recorded in the book of accounts at their acquisition cost. Acquisition means cost of purchasing the assets and expenses incurred on its installation. This cost form the basis for all subsequent accounting transaction of the assets. It means the market value of an asset may change with the passage of time, but no adjustment is made for any change in the market value of such assets in the book of account. Increase or decrease in the market value of assets would not be recorded in the book of account. Assets is recorded at cost at the time of its purchase, but it is systematically reduced by charging depreciation. The market value of an asset may change with the passage of time, but for accounting purpose, it continues to be shown in the book of account at its book value, which is purchased minus depreciation provided up to date. Matching principle. Accurate determination of net profit required that only the expenses related to the revenue pertaining to that particular accounting period should be considered. Thus, there has to be a exercise matching between cost incurred and revenue earned for a relevant period. This concept is particularly known as matching principle for cost and revenue. Next one is duality principle. According to this principle, every transaction has two aspects. First one is debit and another one is credit. Each and every debit has one credit and each and every credit has correspondence and equal amount of debit. This is the underlying assumption of this concept, which is known as balance sheet concept. As per this concept, the two sides of balance sheet always have equal total. The accounting equation is also based on the principle of duality. An accounting equation is relation among assets, liability and capital, which can be observed as follows: assets is equal to liability plus capital. Next one is principle of revenue recognition. The accounting principle of revenue recognition suggests that revenue must be recognized when the rewards and benefits associated with goods or services being sold or rendered have been transferred to the buyer, and the value of such rewards and benefits can be estimated with reasonable reliability although their convey is due. For example, an enterprise sold goods in February 2019 and received the amount in April 2019. Revenue of this sale would be recognized in Feb 2019. That is when the goods are sold, because the legal obligation to receive the amount is established in Feb 2019. Next one is verifiable objectivity. This principle of accounting requires that all accounting data must be free from personal bias. It should always have to supported by source of document, evidence such as invoice, cash memo, bill, debit note, credit note, etc. And this is turn confirms the objectivity, reliability and dependability of the accounting data and the financial statement prepared from it. This principle is foundation on which the confidence of various stakeholders in financial statement of a company is maintained. Thank you. Have a nice day.